Hey, what's up, everybody? It is Friday, April 1st, April Fool's Day. I think the market fooled a lot of people today. We had all day long focus on the yield curve. We had a 2 year, 10 year go inverted. Everybody freaking out about that, but we had a nice positive close at the end of the day. Fuck plan B. Just make plan A work. And let's talk about that whole yield curve thing because I know a lot of people are, really, really focused on that. And I have to say, I think that whole inverted yield curve, whatever you want to call it, myth, and that's what I think it is. I really think it is a myth. I think that saying the yield curve is inverted and then 3 years from now there's going to be a recession, I don't think that's useful information. And it could be other reasons. Look, I have been shown charts where there appears to be a correlation between the inverted yield curve and appearances of recession, but there is that time lapse. So the usefulness of it to me is kind of, minimal. But there could also be other reasons for that. I'm not going to get into that here now. I just want to make one point where I think that the whole yield curve inversion thing as a predictor of recessions is incorrect. And basically, it's based on a belief that banks borrow money and lend it out. See, that's, if you ask anyone or if you listen to the reasons why supposedly the inverted yield curve is negative, is because they tell you that banks borrow short and lend long. And that's completely false. I mean, banks don't borrow to lend. All right, loans themselves create deposits. And banks will lend based on the credit worthiness of the borrower, and as long as they have sufficient capital to make the loan. They're not constrained in any other way. Furthermore, they'll price the loan based on the quality of the asset and the credit worthiness of the borrower. You know this, like if you ever went to get a loan, if you have good credit, you're going to pay a lower interest rates. If you have shitty credit, you're going to pay a higher interest rate. You maybe won't even get the loan. And depending on what you borrow against, I mean, if it's real estate, it tends to be low. I mean, mortgage rates are still low. If it's an automobile or something of that nature, it's going to be higher. In some cases, substantially higher. So it's not about the shape of the yield curve. And this implication that, banks go out and borrow money to lend, I mean, that's just completely wrong. That is completely false. Now, they do pay interest on deposits, but the rate they pay on deposits is far below, what they're earning on loans. So that is not a factor. That is absolutely not a factor. Furthermore, it kind of implies or suggests that bank lending is the primary driver of the economy. Now, bank lending is an important factor in the economy. There's no question about it. And like I've been talking about bank credit growth now for a while and how that has been a plus in terms of we're seeing somewhat of a slowdown in the fiscal. So to have bank credit expanding at the same time, that offsets the slowdown in the fiscal. And by the way, that's natural. When you see the government pulling back, it necessarily creates higher credit demand and higher indebtedness on the part of the non-government. But that's a whole separate topic that I'm not going to get into to discuss. But again, if the whole belief is that it's all about banks not lending, and of course it's not a function. It's not a question of not lending. Let's say a slowdown in lending because of the curve, the shape of the curve. It ignores the fiscal aspect. And I don't think you can ignore that. I think that's very, very important. And I'll give you a perfect example. In the pandemic in 2020, we saw, and I was talking about this at the time, we saw an enormous contraction in bank loans. I mean, a serious, serious decline. It wasn't just simply a slowdown in lending. I mean, we saw a drop of, huge proportions in bank lending. And it had no negative effect on the economy because the fiscal was enormous at that time. So you have to look at these things in all of its parts. You can't just say, okay, the 2-year, 10-year is now inverted, and that means we're going to have a recession. I mean, that is so simplistic, and it leaves out so many other elements that are fundamental to the economy. So, and again, this gets back to what I've been talking about for the last few days on these videos, that, we're in this real-time laboratory right now where we are going to get to see the outcome. I mean, the Fed's going to start raising interest rates next month. And what's interesting now is that we have seen a huge sell-off in the bond market. We see interest rates up. We see the 10-year up at 2.4%, 2.5%, whatever. It was 2.3 something yesterday. It jumped up again today to 2.4. And we had one interest rate hike of 25 basis points. Now, I understand that the market is now pricing in. The market's already pricing in. If you go out, if you look at the FedWatch tool that the CME has, and you could see the probabilities that are baked into how Fed fund futures are trading. If you go out to July 2023, they're looking at a 3.25% to 3.5% Fed funds rate. And on this alone, I'm curious because, I spoke about this a couple of weeks ago when I said, look, the Fed made 111, or it turned over 111 billion last year to the Treasury, or it was something like 108 billion, maybe. Yeah, it made 111 billion on its asset holdings. And it turned over 108 billion to the Treasury, which it's required to do. It turns over all of its income every year except what it needs to operate. And so on 9 trillion in assets, basically, what we're talking about, it made 1%. So 1% on 9 trillion, that's what's what. It's 100, 90 billion, 100 billion. Let's round it off. We'll call it 100 billion. It made 1%. I mean, if it goes up, if it's got 9 trillion in assets and it goes up to what, 2%, right? I mean, it's wiping out all of its gains. It's wiping out all of its profits. 2% on reserve balances. Let me clarify. Reserves now, what you're talking about? Let's round it off. 4 trillion. If it goes up, if they raise the rate to 2.5%, it will have to pay 100 billion on reserve balances. If it went up to 3%, it's got to pay 120 billion. If it went up to 3.5%, what's that? That's another 50 billion. So they have to pay 170 billion. It doesn't have that. It would have to pay more than it's earning on its assets. And so I'm skeptical that they could go up past, 2.5%. We're going to see. Now, I said before that the Fed presumably can continue paying interest on reserves. It'll just run at negative cash flow, and then at the end of the year, it'll have nothing to give to Congress. I would love to see that scenario come to fruition, because I would like to see what the reaction would be by the Fed and by Congress. I mean, what's the Fed going to say? They're going to go to Congress and say, sorry, we don't have anything to give you. We ain't got nothing. And not only that, we got negative cash flow. And we can't even pay for our own operations. So can you help us out? Then what do you think the response by Congress is going to be? They hate the Fed. I mean, that would be like wild, man. I would love for that to happen. So, what's the expression? We're living in interesting times. And we're going to get to see all this stuff play out. Hopefully, I want to see this stuff play out. But again, getting back to the whole thing about the inverted yield curve. I mean, think about it. Has anyone even explained why that is negative for the economy and why that's a predictor of a recession? The answer they give you is because, banks can't lend because they borrow short and lend long. And that is just wrong. That is wrong. So we're going to see. And I just think that we're not going to have the negative reaction. Inflation is a problem, and inflation is a subtraction from GDP. It does slow down growth. But like I said in prior videos, the key thing here, I think the key thing here is that the U.S. is a net exporter of oil. So again, to repeat, we're not in the same situation as we were in the 1970s. But we do run large trade deficits. And to the degree that we're transferring income abroad, if prices are rising, if import prices are rising, that's a problem. That is a problem. I'm not going to say it's not. And this is one of the factors right now that's contributing to the weak forecast for first quarter GDP growth. But right now, actually, the forecast, if you look at the evolution of these forecasts since the beginning of the year, they've been actually getting better. And I mentioned that. I mean, they were like 0% growth. Then it was a little bit negative for a while. Then it popped up back again to, 0.5. Now it's like 1.3% growth. At least that's the Atlanta Fed's forecast. And you have private forecasts that are anywhere in the range from like 1.5 to 3%. And that's consistent. I think that's consistent with, if you look at the fiscal flows and you look at inflation and you kind of, make a rough calculation on what the subtraction would be from inflation, I think that makes sense. I think 1.5, anywhere between 1.5 to 3% makes sense. So it's not negative. That's not negative. And again, we'll see what happens when the Fed starts raising interest rates, but I'm very curious. Because my position is that that's a fiscal expansion. It's going to flow through in higher interest payments from the government into the economy. And I talked a lot about QT and how that's not a T. It's not a tightening. I've been explaining to you guys how reduction in the Fed's balance sheet, if it results in a reduction in reserve assets in the banking system, then that just frees the banks up to hold other assets like securities, treasury securities, and loans and MBS. I don't see that as a negative thing. So a lot of this stuff now for me is just, it's ignorance and it's hysteria. But what else is new? Right? I mean, this is the way the world works, man. And you got to go against that. Now, if I saw fiscal really coming down, by the way, March ended up with a 633 billion for the month of March. There's still indications that IRS tax refunds are still coming out slow, so that could help April. April is, kind of a rough month because you got tax filings, and that, that's a big drain on people's savings and income. But then it gets spent right back out again. The government it goes into the Treasury's account, and then they just use that, for current spending. So it flows right back out into the economy, but it takes a little bit of time. But if we have tax refunds coming out still in April, at a decent clip, that could mitigate some of the negative impact from the normal April seasonal tax filing drag. So I'm hopeful for that. And the deficit in March, if I got my number right, I think it ended at about 197 billion. So if you extrapolate that over 12 months, that's 2.4 trillion deficit for the year. You know, that's down. That'll be down about 500 billion from last year, which, you know, that's not good, but it's not enough to kill us. I mean, it's not enough to wipe out the economy. A 500 billion drop from a 2.9 trillion deficit to a 2.4 trillion deficit. I mean, it's not like we're going to a balanced budget or anything like that. So as far as I could see, everything's still positive. I mean, you still have to buy the dips. We're shaking out some. Look, the AAII weekly sentiment survey that we ran through the week of March 30th, that showed a very big drop, or it was another drop in bearish sentiment. So I mean, you got to kind of work that out. I mean, the selling now, you know, the pullback now, this kind of market digestion, this rotation that's going on. I mean, that just, for me, is tied to this drop in bearish sentiment. A lot of the bears moved into the neutral camp. You still want to see them go into the bullish camp. That hasn't happened yet. And like I've been saying, we'll be talking about that when it does. Anyway, that's it for today, folks. Enjoy your weekend. See ya. Bye.